Thank you guys for clicking on today's video. Today we'll be going over options. Basically what an option is, it's a contract between a seller and a buyer. There's two sides of every contract. The easiest way I can explain it is think of options as a form of insurance. When the underwriter writes his insurance contract, he tells the insurance owner, hey, if you pay me this amount of money, I will insure your vehicle up to this amount if you choose to exercise your contract or if you need it. The buyer can then decide if he would like to buy this contract or not. Now, just like insurance, you might not always need it. If your car insurance expires and you never used it, it almost feels like you wasted all that money paying that insurance since you never got in a car accident. And same thing with stock. You might have bought this option in case your stock were to either shoot all the way down or shoot all the way up, but you ended up never needing it. Hence why when it gets to an expiration date, while your account goes to zero, whereas if you're the seller, your account was debited that amount when you first wrote the contract and sold it, and now the expiration date has come, you got to keep all that money. The main things that you need to know about a contract are the Greeks. For example, delta measures the sensitivity of the stock, gamma measures the rate and change of delta, vega measures implied volatility, and theta represents time decay. Another thing you need to know about options is that the strike price, you have to multiply that by 100 to find out how much you're paying per contract. When dealing with options, time is always working against you unless you're the one selling a contract, in which case your account got debited and you're kind of hoping for an expiration date to come. The next thing you need to know is that calls mean you believe the stock will go up and puts mean you think that the stock will go down. When buying and selling options, a really easy platform to use is actually Robinhood, and I'm assuming most of the people watching this video actually use Robinhood to buy and sell options, in which case the form you guys are using when you're doing that is, let's say you buy a call option and you're hoping a stock goes up, is because you're the buyer in that case, protecting your stocks, even though more than likely you probably don't even own those shares. Since you're just trading options, you're not really hedging your own account. Just know when you're buying a contract in those situations, the person who sold that contract is hoping for the opposite of what you're hoping for. Since you're hoping the stock is going to go up, they're hoping that stock is going to go down. And remember, the owner of a contract has rights, the seller of a contract has obligations. So this was just a quick little video explaining options and some basics that you guys need to know. Leave some comments in the comment section below if you want me to go over some of the multitude of strategies that there are that involve options. But these are just the basics. So I hope you guys liked the video. Remember to leave a like, comment, and subscribe for more future content.